I see a lot of Canadians making RRSP contributions based on a calculation of how much of a refund they're going to get. In this video, we are going to talk about why that is a very flawed approach to making RRSP contributions. Hi, my name is Shyam Ganesh, and I'm with Grow Your Wealth Financial Planning. Today we're going to talk about a mistake that I see a lot of Canadians making, whether employees or business owners. And this is specifically around tax time and around RRSPs. So every January and February, there's a flurry of Canadians who are approaching their banks, their investment advisors, and their tax advisors, their tax filers, asking the question, how much should I contribute in order to make my tax owing zero if there's a balance, or how can I increase my refund? How much should I put in order to get the maximum benefit? And I really think that this is a flawed approach to making this decision because first of all, the premise of an RRSP is that you are deferring taxes. So any savings that you have are not true new savings. They're just a deferral of the taxes. So you're going to still owe those taxes at a future point in time. And so really, here's what I think you need to consider in order to make an informed decision on whether or not to do RRSPs, and if so, how much to do it. So there's three things. Number one is what are you expecting to make in retirement? So are you expecting to make as much of an income, like an equivalent, like do you plan to live a similar lifestyle in retirement as you live now? Or do you expect it to be higher or lower? And that question kind of relates to the second point, which is what are the tax rates going to be? What do you expect them to be, 10, 20, 30, 40 years from now? So for example, if you put $1,000 into an RRSP and you're in a 35% tax bracket, you're getting $3,500 in a deferral or savings. And so are you expecting to be in a 35% tax bracket or lower when you go to withdraw the funds? Because if not, if you're expecting the tax rates to have gone up, or if you're expecting to make an equal amount of income or higher amount of income in retirement, well, maybe you could be paying 40% when you take it out. And so, you have to consider, those two things, like, how much are you expecting to make and what are you expecting tax rates to do? And then the third factor is, what else do you need the money for? So when you put money into an RRSP, it's literally in jail until you can retire, until you decide to pull money out of it. So I don't like the word retirement, but when you start pulling money out of it, you're going to that's when you can use it. But what if, there's investment opportunities or other goals you have that you need that money for along the way? Then what? You don't really have access to it. Yes, there's the home buyer's plan, there's the education plan, but those are all plans that you have to pay back. And there's an opportunity cost when take money out of the RRSP for a home purchase. You're not getting the growth that you would have if you had not taken it out, and then you have to repay it within X number of years. And so there's always a cost. So it looks like a nice tax savings, but there's a flip side. There's a cost to locking money into an RRSP. And so really the best way is to have take a more nuanced approach, like make it part of a larger plan where you know what your goals are, you know what you need funding for, or at least you have money set aside for the emergencies and things that might come up. And you have kind of a plan for, okay, I want to invest in real estate, and so where should I save money for that? Or I want to buy a car, where should I save money for that? And then make a decision as to whether which type of account it goes into. You have alternatives even for retirement. RRSPs are not the only place where you can put money that's set aside for the long run. You can do that in a host of other places where you've got some benefits and some disadvantages. And so making it part of a more holistic plan will give you the confidence that when you make an RRSP contribution, it's not just about saving a few dollars this year, because really it's not a true savings, it's a deferral. And the reason you're doing it, and the impact to your overall finances in the short but also long term is truly positive. So anyway, if you're curious about how to put this plan together, please fill out the questionnaire below, and that will qualify you for a 30-minute consult with our team at Grow Your Wealth Financial Planning. And we very much look forward to learning about your situation and answering any questions that you have, so that you can just be way more confident in your financial decisions. Thank you so much for joining us today, and I look forward to seeing you on the next video. Please do comment, like, share below, and if you do have any other questions you'd like us to be answering, please do let me know, and I would be very excited to to discuss. Have a great day.